Section 1. In the mid-1990s, the skyline of Bangkok was not merely a collection of concrete and steel. It was a physical manifestation of a seemingly unbreakable economic promise. They called it the Asian Miracl. Cranes dominated the horizon, luxury imports flooded the streets, and the gross domestic product of Thailand was expanding at a pace that made Western economies look sclerotic. Investors believed they had discovered a perpetual motion machine of wealth, a system where risk had been engineered out of existence. But beneath the glittering surface of the Fifth Asian Tiger, a fundamental law of economics was being quietly yet violently violated. The prosperity was not built on productivity, but on a structural contradiction that was ticking towards 0 hour. Now let's open the ledger and audit the system that determined the cost. To understand the autopsy of the Thai baht, we must first consult the Mundell-Fleming Trilemma, known more ominously in financial circles as the Impossible Trinity. This economic axiom posits a strict limitation on national policy. A country can maintain only two of the following three conditions simultaneously: a fixed exchange rate, free capital movement, and an independent monetary policy. Attempting to hold all three is an act of systemic hubris that inevitably results in a breakage. When we audit the books of the Bank of Thailand in 1996, we see a central bank attempting to defy this gravity. First, let us examine the fixed exchange rate. For over a decade, the Thai baht was effectively pegged to a basket of currencies dominated by the US dollar, trading in a tight band around 25 baht to $1. This peg was the anchor of stability. It promised foreign investors that their returns would not be eroded by currency fluctuation, effectively acting as a state-sponsored insurance policy against volatility. Second, consider the free capital movement. In an effort to transform Bangkok into a global financial hub rivaling Singapore or Hong Kong, the government established the Bangkok International Banking Facility, BIBF. This deregulatory move tore down the walls guarding the domestic economy, allowing foreign capital to flow in and out with virtually no friction. Third, there was the independent monetary policy. To combat overheating and inflation caused by rapid growth, the Bank of Thailand kept domestic interest rates high, often significantly higher than rates in the United States or Japan. Here lies the mechanism of the trap. The Bank of Thailand had created a fatal incentive structure. By maintaining high domestic rates and open capital borders, they invited the world's liquidity to enter. Simultaneously, by guaranteeing the exchange rate at 25:1, they removed the perceived risk of doing so. This created a massive arbitrage opportunity. A Thai developer or a finance company could borrow dollars from New York or Tokyo at 5% or 6%, convert them into baht, and lend them out in Bangkok at 15%. As long as the peg held, this was essentially free money. The result was a deluge of hot money, short-term speculative capital flooding into the Thai system. The ledger reveals that by the end of 1996, Thailand's private sector external debt had ballooned to nearly $70 billion, a staggering portion of which was unhedged short-term debt. Corporations were treating the 25.1 exchange rate not as a policy target, but as a law of physics. They built skyscrapers, golf courses, and luxury condos financed by loans that required the baht to remain stable forever. However, the Impossible Trinity dictates that you cannot keep your interest rates high to attract capital, while simultaneously fixing your currency if the external environment changes. As the US dollar strengthened in the mid-90s, the baht, chained to the dollar, appreciated with it, making Thai exports uncompetitive. The economy began to slow, but the debt service remained. The market began to sense a misalignment. The central bank was now in the precarious position of defending a currency valuation that no longer reflected economic reality, using reserves that were finite against a global capital market that was effectively infinite. The trap was set. The tiger was in the cage, and the lock was beginning to rust. Section 2. By early 1997, the disconnect between the Thai economy's slowing pulse and its feverishly high currency valuation was no longer a secret. It was an invitation. In the ruthless logic of global macro finance, a fixed exchange rate that deviates from economic reality is not a policy, it is a target. Hedge funds and proprietary trading desks, sensing the fragility of the Asian Miracl, began to test the perimeter fences. They initiated what we euphemistically call speculative attacks, but which in forensic terms were simply massive short-selling campaigns against the baht. The mechanics of the assault were elegant in their brutality. Speculators would borrow billions of Thai baht from local banks, sell them immediately on the spot market for US dollars, and wait. Their thesis was simple. The Bank of Thailand would eventually run out of dollars to defend the peg, the baht would crash, and the speculators could buy the baht back at pennies on the dollar to repay their loans, pocketing the difference. The Bank of Thailand, however, was not a passive victim. It was an institution manned by technocrats who believed they could outmaneuver the market. But as we conduct the autopsy on their defense strategy, we uncover a catastrophic mismanagement of liquidity. The central bank fought back on two fronts, the spot market and the forward market, and it is in the shadows of the forward market where the lethal blow was self-inflicted. On the surface, the Bank of Thailand appeared robust. Throughout the spring of 1997, official reports showed foreign exchange reserves hovering around a healthy $30 billion, seemingly enough ammunition to repel any attack. But this figure was a ledger illusion. As the selling pressure intensified in May, the central bank didn't just sell its existing dollars, it entered into massive forward contracts. A forward contract is a promise to exchange currency at a set price on a future date. To keep the spot price of the baht at 25.1 without depleting their reported current reserves, the central bank effectively bought baht and sold dollars in the future. They were mortgaging their future liquidity to survive the present day. They were betting that the speculators would lose their nerve before the contracts came due. When we look at the classified data that was later revealed, the scale of this gamble becomes terrifying. While the public balance sheet showed $30 billion in reserves, the net reserves, once the forward obligations were subtracted, had collapsed to a mere $1.14 billion by June. The country was running on fumes. The vault was empty, but the accounting rules allowed them to keep the door closed and pretend the gold was still there. The psychology of the market is predatory. It hunts for weakness. By late June, the interbank lending markets began to seize up. Trust, the most critical asset in any financial system, evaporated. Local Thai banks, realizing that the central bank was fighting a losing war, stopped lending to each other. The velocity of money slowed to a crawl. The government issued stern denials, with the Prime Minister famously declaring on television that the baht would never be devalued, a classic signal to historians that devaluation is imminent. The breaking point arrived on July 2, 1997. With the forward book completely saturated and net reserves effectively negative, the Bank of Thailand capitulated. They announced the float of the baht. The terminology suggests a gentle drifting, but the reality was a violent capitulation. The peg was cut loose. The immediate reaction was a chaotic repricing of value. The baht did not float, it sank. Within weeks, it had lost nearly half its value, plummeting from 25 to the dollar to over 50. This is where the liquidity crisis transformed into a solvency crisis. Let us re-examine the balance sheets of the Thai corporate sector we discussed in the first section. Recall the free money they had borrowed, the billions in unhedged US dollar debt. A real estate developer who had borrowed $100 million previously owed 2.5 billion baht. Overnight, that same debt obligation swelled to 5 billion baht. Their revenue, however, was still in local baht, derived from condos and office rentals that were suddenly empty. The leverage ratio, which had fueled the boom, now acted as a guillotine. The liabilities of the nation's largest companies doubled in local currency terms, while their assets, inflated property and stock portfolios, collapsed in value. This is the balance sheet mismatch that defines emerging market crises. It wasn't just that they ran out of cash, it was that they were technically insolvent. The debt load exceeded the total value of the assets. The banking sector, the conduit for all this hot money, faced an immediate liquidity freeze. Non-performing loans, NPLs, skyrocketed as borrowers defaulted en masse. Finance companies, the shadow banks that had aggressively lent to the property sector, were the first casualties. The government was forced to suspend the operations of 58 out of 91 finance companies. Depositors panicked. The images from Bangkok in July and August of 1997 are haunting. Lines of terrified citizens queuing outside banks, desperate to withdraw physical cash before the shutters came down. This was the death spiral of liquidity. As banks hoarded cash to survive, they stopped lending to healthy businesses. The credit crunch strangled the real economy. Factories couldn't get letters of credit to import raw materials. Exporters couldn't get working capital to ship goods. The circulatory system of the economy had entered cardiac arrest. The contagion did not stay contained. The Asian flu spread rapidly to Indonesia, South Korea, and Malaysia, but the patient zero, the autopsy subject, lay in Bangkok, a victim of attempting to defy the Impossible Trinity with an empty ledger. Section 3. When a sovereign nation runs out of liquidity, it does not simply declare bankruptcy and restart. It surrenders its economic sovereignty. In August 1997, the ledger of the Kingdom of Thailand was effectively handed over to the International Monetary Fund, IMF. The arrival of the IMF acts as the coroner in our autopsy, confirming the time of death for the Asian Miracl. The bailout package was headline-grabbing, $17.2 billion in emergency credit lines. But as any forensic accountant knows, this capital came with strict covenants. The IMF diagnosed the patient with structural excess and prescribed a regimen of brutal austerity. To stabilize the bleeding baht, they demanded the maintenance of punishingly high interest rates. While this theoretically incentivized capital to stay, in practice, it suffocated the domestic economy. The verdict of the Impossible Trinity was rendered absolute. The crisis proved with violent clarity that the laws of economics are immutable. Thailand had attempted to cheat the triangle, keeping the exchange rate fixed, capital flows open, and monetary policy independent. The market's correction was the penalty for this violation. The peg was not a shield. It was a dam that held back the volatility until the pressure became catastrophic. When the dam broke, the floodwaters didn't just normalize the price, they drowned the village. The cost of this insolvency was transferred from the balance sheets of banks to the livelihoods of the population. We witnessed a fire sale of national assets. Thai finance companies were shuttered, their assets auctioned off to foreign investors at fraction of a penny valuations. Unemployment doubled. The poverty rate, which had been steadily declining for decades, spiked. The Tom Yum Kung crisis, as locals call it, was not merely a correction of asset prices, it was a destruction of the middle class's savings. However, the autopsy reveals a pivotal shift in global financial architecture born from this wreckage. Post-1997, the Asian tigers learned a lesson that dictates market behavior to this day. Liquidity is national security. Never again would these central banks rely on the kindness of strangers or the stability of a peg without the ammunition to defend it. This trauma is why today Asian central banks hold trillions in foreign exchange reserves. They built war chests not for investment, but as insurance against the return of the trilemma. They learned that in the global casino, you cannot play with a fixed hand if you are borrowing the chips. The system eventually stabilized, and the baht found a new equilibrium as a floating currency. But the scar tissue remains on the charts. The crisis exposed the fundamental fragility of the modern monetary system. Trust is the only reserve that truly matters. When the ledger is opaque and the liabilities are hidden in forward contracts and offshore entities, the market will eventually demand an audit, and the market's audit is always merciless. We close the file on 1997 not with a judgment of blame, but with a recognition of gravity. Money, at its core, is a social contract, a collective agreement on value. The Asian financial crisis reminds us that this contract is fragile. Wealth that is built on leverage and sustained by an artificial peg is not wealth at all. It is a hallucination. When the liquidity tide goes out, the ledger reveals the only truth that endures. You cannot borrow prosperity, you can only earn it.